Hi, everyone. Welcome to the webinar today. Thank you so much for joining. My name is Alexandra Alvarado. I'm the Director of Marketing and Education here at the American Apartment Owners Association. I'm so glad that you could join us today. We have a lot of information to go over, but before we get started, I'm just going to go over some housekeeping items. One is that this whole thing is being recorded, so please take notes and listen, but we will be sending you everything tomorrow that you can rewatch just in case you miss anything. We are scheduled to be here for about an hour, but depending on how many questions we have, that may be more or less. And we will be taking questions at the end of the presentation. So make sure that you put your questions in the question box whenever you think of something, not the chat. The question box helps us to organize the questions a little bit better. And also, I encourage you to take our exit survey as you leave so that we can get your thoughts on this presentation. So with all that being said, I'm happy to introduce Matthew. Matt McFarland, he's the Senior Vice President at K Properties and Investments, LLC. He's going to be our speaker today. K Properties is headquartered in Los Angeles, and they help clients with 1031 exchanges and direct investments. Matt has previously worked at national commercial real estate tenant representation firms, where he was involved in representing tenants in their leasing of commercial office and industrial and flex space. I love that you have a background with tenants. That's a really interesting perspective to bring to the table. And then since joining K Properties, Matt has participated in over 1,300 transactions and over $15 billion worth of real estate. That is really quite impressive, Matt. He works hand in hand with all the K Properties senior VPs, educating clients on what particular investments make sense for their situation. He graduated UCLA, has a Bachelor of Science in Psychological Science, or Physiological Science, sorry, from the UCLA Department of Integrative Biology and Physiology. Interesting background there, Matt. I'm so happy to have you with us. Thank you for taking the time. I'll go ahead and hand over this presentation to you, and you can take it away.
Well, thank you so much, Alexandra, for the introduction, and thank you to all of the attendees. Really appreciate your time today, and hope that you come away with some new knowledge. You'll find that with K Properties specifically, a really big part of our role is to educate our investors. We take that very seriously. And we've designed this presentation to hopefully provide a little bit more insight, specifically into the Delaware Statutory Trust properties. These are, larger passive real estate investments that are built for 1031 exchange investors. So I'm going to map out the presentation in just a minute here, but if you'll bear with me, I'm just going to go through a couple of risks and disclosures. From a compliance perspective, we have to do this. So the information herein has been prepared for educational purposes only and does not constitute an offer to purchase securities, DST properties, and/or real estate. Such offers are only made through a private placement memorandum, which is the official offering document for these investments, which is solely available to accredited investors and accredited entities. DST 1031 properties are only available to accredited investors, which generally means an individual with a net worth of over $1 million, exclusive of their primary residence, and or accredited entities, which is or an entity with gross assets of $5 million or more. We always encourage investors to speak with their CPA, their tax attorney, to determine if they are indeed accredited. These concepts that we're going to be talking today of Section 1031, IRC Section 1033, and IRC Section 721. Once again, we always encourage folks to consult their tax and legal advisors for the specifics of their situation prior to considering an exchange or an investment. There are risks associated with investing in real estate, in DST properties, as in real estate securities, including loss of principal, illiquidity, tenant vacancies, interest rate risk, declining market values, and general risks of owning and operating real estate. For investors to qualify for these investments, there are financial and suitability requirements that must match specific objectives, goals, and risk tolerances. There are scenarios included in this presentation. They're hypothetical, not included to represent an actual investor situation. Each investor situation is different, and want to make note of that. Diversification does not guarantee profits or guarantee against losses. Past performance is no indication of future returns. Potential cash flows, returns, and appreciation are not guaranteed and can be lower than anticipated. Once again, we encourage all investors to read the private placement memorandum in its entirety, paying special attention to the risks section prior to investing. All information is provided for educational purposes and is general in nature, and securities are offered through Finex Capital, member FINRA, and SIPC. So thank you for bearing through that with me to start things off. So what we are going to talk about today, we're going to start with setting a baseline of understanding. Many of you who are a part of the webinar today, I'm sure are very familiar with the concept of a 1031 exchange, but we are going to review that just so everyone has a firm foundation with which we will build upon as we move into unpacking specifically the Delaware Statutory Trust properties, which once again are 1031 exchange eligible passive investments. And then from there, we're going to show just a couple of examples of past projects. We're going to touch on the due diligence process that K Properties brings to this space. And then lastly, to close, we're going to just talk a little bit about our platform and what we believe separates us from others. So jumping right in here with the 1031 exchange, the section 1031 exchange has been a part of the Internal Revenue Code going back all the way to 1921, if you can believe that. So it's over 100 years old. And effectively, what it allows investors to do is to defer capital gains taxes, other taxes that would ordinarily be due upon sale of investment real estate, so long as they follow a set of obligations that the IRS sets out, and that money is reinvested into other 1031 exchange eligible investments. So here's an excerpt from the actual code itself. No gain or loss shall be recognized on the exchange of property held for productive use in a trade or business or for investment if exchanged for another like-kind property, also to be held for productive use in trade or business or for investment. So it's important to take note of that. We're gonna touch back on that in a few minutes here. But once again, investment property must be exchanged for another investment property. That is the key foundation to making this the 1031 exchange work. So a couple just basic requirements to successfully complete a 1031 exchange. The first and arguably most important part of everything is the use of a qualified intermediary. So a qualified intermediary, think of it as another escrow account. A qualified intermediary is an administrator of the exchange. Most qualified intermediaries are going to be connected to a title company. It's a separate kind of division of their operation. And their sole job is to receive the funds from the sale of the relinquished property, the investment property that's being sold, and to administer those funds through to the replacement properties that the investor ultimately chooses to be a part of their 1031 exchange. And this is really, really important because the IRS makes it very clear that a 1031 exchange investor is not allowed to take constructive receipt of their funds. So in other words, if the funds from the sale come into one's direct possession, they are disqualified from the ability to do a 1031 exchange. So there has to be this intermediary to receive and administer those funds through to the next investment. This needs to be set up prior to the relinquished property officially closing, as you can imagine. And the account information would be written into the escrow instructions so that escrow properly sends those funds to this qualified intermediary. So very, very, very important. Number one, investors must not take constructive receipt of the funds. It must go through a qualified intermediary. That is not a service that K Property provides. That would be a kind of a neutral third party to the whole transaction, and happy to provide references if helpful to any prospective client or client. Number 2 and 3 have to do with the dollar value part of the equation. So simply put, an investor must reinvest 100% of the net equity or the cash that's generated from the sale of the relinquished property. And they must replace equal or greater value in replacement properties as they had of relinquished property. So what this means, if you sell for $2 million, you must purchase real estate for $2 million or more in order to entitle yourself to full tax deferral. What's really important about this is if there is a mortgage that's paid off at closing, a mortgage that's on the relinquished property, that value also must be replaced, right? Because it's not just that you reinvest all the cash, it's that you reinvest all the cash and you replace the value of the debt as well. We're going to talk about this in a little bit more detail going forward, but I want to draw your attention to this because that's another common misconception that a lot of investors have. For those who are selling a property free and clear, they obviously don't have to worry about replacing debt. And number 2 and 3 effectively are the same requirement, right? They're selling on cash. The net proceeds is their cash value. So they won't need to, like I said, worry about getting another mortgage. Number 4 and 5 have to do with the time requirements that are placed on a 1031 exchange. So number 4 is the most difficult part of all of this for investors. It is the dreaded and infamous 45-day identification period. So what that means is investors have 45 days or roughly 6 weeks from the time that they close on the relinquished property to formally identify the property or properties they intend to acquire with the qualified intermediary. So all they have to do is submit a list, right, of properties. There's a few different ways that properties can be identified. We're not going to go into that for this conversation. But you can imagine with a traditional real estate transaction of the initial search through the due diligence period to actual close, we're talking about 30, 60, maybe even 90 days, which exceeds in many cases the 45-day identification period. So a lot of investors are scrambling within this period to find properties that not just that they like, but properties they actually think they're going to be able to close on. Because once you get past day 45, once you get into day 46 and beyond, the investor is limited to purchase just the properties that they identified on that initial identification list that was submitted or needed to be submitted within 45 days. So that's a sticking point for a lot of 1031 exchange investors. I always joke that the IRS designed it to be difficult with respect to this time frame specifically. Why? Because they likely want investors to to pay the tax and not be able to defer that, going forward. Of course, I have no way to completely verify that. That's just my sneaking suspicion. Number 5, 180 days. So an investor has 180 days from the time that they close on the relinquished property to actually close on their replacement property or properties. This is usually not as difficult for investors as that 45-day identification window. Here's just a representation of what we talked about with respect to timeframes: close of escrow, 45 days, 180 days. So talking about like-kind property, this is a common misconception that investors have, where they confuse like-kind property to refer to the asset class or property type that they're selling. So investors sometimes think, oh, if I sell a residential property, does that mean I have to buy another residential property? And that's actually not correct. So like-kind refers to the nature or character of a property, and that it must be held for productive use in trade or business or for investment, as we talked about in that excerpt a few slides ago. So what this means is that, office properties can be exchanged for apartments, apartments for raw land for industrial, single-family rentals for duplex, farmland for apartments. And then lastly, any type of investment real estate exchanged for a Delaware Statutory Trust property. And this is where we're going to spend the remainder of the conversation today, is digging into the Delaware Statutory Trust properties, which function as an option for investors to consider, accredited investors to consider, as they move towards and through a 1031 exchange. So starting out with some just basic frequently asked questions. First, the most obvious: what is a DST 1031 exchange property? Simply put, this is a type of replacement property that can be used for 1031 exchange as well as for direct cash investment. So they can be accessed, in both forms. And the unique thing here is that the IRS has approved the use of the Delaware Statutory Trust structure in a revenue code ruling back in 2004-86. And from the early 2000s to today, this has become a multi-billion-dollar industry, and the most popular way that passive 1031 exchange investors who are seeking diversification and some of the other things that we'll talk about in a few minutes are considering for their 1031 exchange needs. So once again, the Delaware Statutory Trust, it's a total mouthful, but really it's just an entity. It's an entity used to hold title to investment real estate in this case. In a lot of ways, it's very similar to other entities, limited liability company, for example. Biggest difference, once again, a DST does qualify as like-kind property. Why? Because of the revenue code ruling that the IRS put out in 2004. Other entities, LLCs, general partnerships, limited partnerships, various funds, REITs, these entities do not qualify for the purposes of a 1031 exchange. So that is the most common difference. The DST structure is essentially set up as a pass-through entity. So what you have a property that is acquired. It is structured as a trust, in this case, the Delaware Statutory Trust. And investors are able to come in and purchase a piece. The specific language is called a beneficial interest in the trust. The trust holds deed to the real estate. The trust is a pass-through vehicle. So depending on the investor's pro rata ownership portion of the DST, they're going to be entitled to every aspect of the real estate. So that includes potential distributions. Most DSTs are set up to pay a monthly distribution, which is the net rental income that is produced by that operating asset. Investors are entitled to 100% of their pro rata portion of the appreciation, potential appreciation of the property, net of closing costs. Once again, this is unlike many forms of private equity real estate, LLCs, LPs, private REITs, where a large portion of the potential appreciation in many cases is given given to the operator, or what we call sponsor, through a waterfall split, promote structure. There's a lot of different ways that these operators can structure these other investment types, but the DST is unique in that it is a pass-through entity, which is going to be really important. Follow-up question to that investors commonly ask is, can I do a 1031 exchange out the other end? And the answer is yes. And a majority of investors do elect to do a 1031 exchange when the DST property that they own interest in sells. Most of the DSTs are held for anywhere between 5 to 10 years, although they can go shorter, they can go longer than that. We'll talk about that a little bit later on. But when the DST property is sold on the property level, that creates a liquidity event for the investors that are involved, that own interest in the trust. And investors are given an election. They can elect to send the money to a qualified intermediary, and the 1031 exchange process starts over. They can elect to take the cash into their own possession. That would trigger a taxable event. But if they elect to go through a 1031 exchange, they are not limited to do another Delaware Statutory Trust. Most investors do because they've enjoyed the experience, they like being passive, but there are investors that will actually transition back to outright ownership, or kind of more of a management intensive ownership class. So this is really important. And the goal for a lot of our investors is to continue to 1031 exchange, continue to diversify into these passive investments. So yes, absolutely, 1031 exchange can be done when the DST property sells. So this next section, we're going to talk about a couple of the unique advantages that come with a Delaware Statutory Trust. I always like to say this: there are two sides to every coin, right? There are certain aspects that the DSTs have that would be attractive to a certain type of investor. And there are certain of these same aspects that would be unattractive, to other investors. So I want to make that very clear. The Delaware Statutory Trust properties, they do not work well for everyone. And when we engage with investors and get to know them and their situation, what we're trying to establish from the very beginning is if this is a suitable investment for them, if this could potentially be, their goals and objectives. And that is the biggest part of the educational push, is arming investors with all the information, answering their questions, and figuring out, is this a viable strategy for what that individual is trying to accomplish? So for an investor who is specifically looking to be passive, this could be an attractive option. And what I like to say is, on the spectrum of passive to active, in the realm of 1031 exchange eligible investments and properties, the DSTs are going to be the most passive way that an investor can invest. This is even more passive than buying, a single tenant triple net property outright, where the tenant is responsible for a majority of taxes, maintenance, insurance. This is set up to be as for those participating. So what does that mean? No more terrible teas, tenants, toilets, and trash, right? I'm sure many of you can relate to that in your own management. And why? Because the DST properties have professional asset and property management in place. So it's designed in a way where a large real estate company is taking care of all the day in and day out aspects of the real estate, anything from property management all the way up to asset level management. And the reason why it's done this way is it's done this way to allow investors to concentrate on other aspects of their life. For many of our investors, that can be family, whether it's kids, grandkids, it can be travel, it can be other businesses, right? We work with CEOs that are, so busy running their own businesses that they don't have time to manage their real estate. So this can be an attractive option for them. Really, this is a lifestyle change, right? This is an exit to active management within the realm of a 1031 exchange, where an investor can transition into a passive ownership role. So that's really key because this works well for some investors, but it doesn't work well for everyone, right? The investor who's trying to be really hands-on and wants to try to squeeze everything out of their investments, this is probably not the right structure for you. So second aspect, potential diversification. So the typical minimums for DSTs are as low as $100,000. So this means that a majority of DST investors are taking advantage of diversification. So they have an exchange for $500,000, $1 million, whatever it is. And instead of transferring those proceeds into buying a single replacement property, they're taking their proceeds and they're spreading it out across multiple different DSTs. And that's a really big part of this approach. We're trying to kind of hedge our bets, so to speak, through diversifying, right? And this could mean diversifying across different property types. So we offer anything from multifamily to industrial, medical, triple net buildings, a little bit of office, retail, self-storage. This could also mean diversifying across debt structures. So some DSTs come with prearranged financing, others come with no financing. So that could be a part of the equation. Another aspect can be through geographical diversification. Maybe we want to invest a little bit in Texas, and maybe we want to invest a little bit in Virginia. The DST structure allows investors to take advantage of that very easily. Another aspect is diversification across different DST companies, right? K Properties, we are an advisor for investors who are specifically seeking to invest in DSTs, and we work with 20 plus different DST operators. We call them sponsor companies. So that could even be a part of the equation as well. I want to highlight the bottom of the screen. Diversification does not guarantee profits and does not guarantee against losses. However, this is a tool that investors have been using, going back a very long time to eliminate concentration risk, right? And that's what we're trying to do, is to, by spreading the equity across multiple investments, mitigating concentration into any particular property type. Because, we've been involved in many different DSTs, thousands of DSTs. We've worked with thousands of investors. We've been very fortunate to have a very large footprint in this space. And, not all of these investments, of course, perform exactly according to plan. Some of them underperform, things happen. Others, might overperform. Maybe some are kind of right in the middle. So if we're able to take a calculated, diversified approach, we're able to hopefully mitigate some of that potential downside that's inevitable to any investment. So kind of shifting gears here a little bit, talking about taxes. Investors will receive a substitute 1099 with an operating statement at the end of the year. So this is going to be provided directly from the DST company to the investor, and that investor is able to pass that information along to their CPA, who's going to plug all the information into Schedule E on the investor's tax return. So from a tax perspective, this functions identically from a reporting perspective as any of your current real estate investment holdings. We're not getting a K1, it's a substitute 1099 that is directly applied to Schedule E of the tax return. So this next section, we're going to spend a few minutes to talk about the financing. This is a really, really important topic in general from a 1031 exchange perspective, especially in today's environment, where we've seen a lot of movement in financing, and we always spend a lot of time educating our investors, first in how this functions in the DST context, but also moving out to more broad stroke kind of realizations about potential risks that financing inherently brings. So if you recall, going back a few minutes, we talked about one of the 1031 exchange requirements to not only spend all of the cash that's generated from the sale, but also to replace total value, right? And I made the distinction that for those who pay off a debt at closing or who had a mortgage on the relinquished property, they would need to replace that value in new financing in most cases. So that functions as another element that comes into play when investors are doing due diligence and trying to acquire different properties. For anyone that's worked with a lender, you know how difficult it can be, how much they require, and to add that on top of the stress of trying to locate a property and do your own due diligence, it can be very, very challenging, especially in today's environment when we're seeing a lot of movement. So the unique thing, or one of the potential benefits that DSTs bring, is they typically have long-term in place fixed rate financing to help mitigate 1031 exchange closing risk. So in other words, the DST properties, they are acquired. As part of that initial acquisition, the DST company will set up and lock on a loan. So they'll bring a certain value of debt to that initial closing, and that value of debt sits in that particular DST investment. It's all set up on the institutional level, but when an individual investor comes in and contributes a certain amount of their equity or their cash value, they automatically are able to assume their portion of that fixed financing that is already a part of that specific real estate deal. And this is potentially attractive for a number of reasons. One, DST investors do not have to go through all the brain damage of qualifying for a loan and getting that set up in the midst of transitioning to DSTs. Number two, in a majority of cases, this financing is 100% non-recourse. So what that means is that investors are not liable beyond the principal, the equity principal that they contribute to that particular property in case of a default, right? Which is different than most kind of traditional loans where the borrower is pledging, other assets as protection, in case of default. So two really important aspects to be aware of. And for investors who need to replace debt, this is a very useful remedy within the realm of a DST specifically. So I mentioned most of these loans are longer term from an institutional perspective. Most of them are 10 years. We have seen some that are shorter. The shorter the loan term, the higher the risk, right? So that's an aspect that we definitely want to draw our investors' attention to. Loans are structured differently. A majority of them, in my experience, are fixed rate loans. So there's a fixed interest rate, and there is a period of interest only term, and a period of amortization. So that could be anything from 5-year interest only, and year 1 to 5, and then year 6 to 10, amortization on a 30-year schedule. It can be amortizing, after the first or second year. There's a lot of different ways that these companies structure the debt. But it is important to be aware that investors do get the benefit of their pro rata portion of any principal paydown. The offering loan to value percentages. So what this means is the value of the loan divided against the total value of the investment offering range anywhere from 35 to 60%. So that's kind of the sweet spot in terms of the percentage value that is inherent in the DST space. The next slides, we're going to talk about the all cash DSTs. So I mentioned this earlier, but there are different types of debt structures. And we do work with many investors who are completely debt free. They're free and clear on the properties that they own. And those investors who are seeking to mitigate financing risk would be attracted, or could potentially be attracted, to all cash debt free DSTs. So going through some of the reasons as to why some of these are maybe more obvious than others. Number one, no refinancing risk. Number two, I find is one of those that is less obvious, is it eliminates the risk of taking on equal or greater debt in future 1031 exchanges. So remember, going back to the 1031 exchange rules at the beginning, an investor must spend 100% of their cash and replace or exceed the total value of what they sold in order to defer all of the taxes that are able to be deferred under the 1031 exchange. So if an investor goes from a debt-free property and invests into leveraged DSTs, when those DSTs sell, they will be responsible for replacing not just the equity value, but also the debt, right? So once you take on debt, you can't go back. So this is another potential mitigation, eliminating the need to continue to replace debt going forward. Number three, provides the investors the ability to diversify. We talked a little bit about that a few slides ago. Number four is really what it comes down to for me. Flexibility to hold through any potential event that comes up: downturns, credit crunches, recessions, depressions. If there's no financing on the property, there is no ability for a lender to foreclose on that property. So this provides the utmost protection of principal. For many of our investors, that's really important. So those investors would be attracted to the debt-free DSTs. Number 5 and 6, less obvious. A lot of these portfolio loans. So if there's a DST with multiple properties and one loan against all those properties, all of the properties are what's called cross-collateralized. So that could limit the ability for the sponsor to sell part of the portfolio off at different times. One property can trigger something even if another property is performing just fine. So cross-collateralization risk, which is found, in some cases. Number 6, no cash flow sweep provisions. So a lot of these loans are packaged in a way, set up in a way where if the property produces below a certain threshold by way of, revenue or net operating income, there's all these different parameters. The bank or the lender could be entitled to sweep any cash flow. And what that looks like is, all the cash flow that's generated goes into a holding account, essentially, that lender controls until the property gets back to a place above whatever the threshold is that's considered healthy, and then the cash would be released. Sometimes the debt-free DSTs can have lower fees than the leveraged DSTs. Allows investors to protect themselves. We talked about this. Number 9, there's no balloon mortgage maturity. So the way that these 10-year loans, 7-year loans, these various loans are set up is there's a maturity event. And, prior to that, the entire remaining balance of the loan must be repaid. And you can imagine that creates some pressure for the DST operators to sell within a certain period of time. Number 10, prepayment penalties, right? We don't have to worry about that if we're in a debt-free DST. So this next section, we're going to talk a little bit about the mechanism of how a DST is acquired. So in terms of actually closing on a DST, a typical DST property can be closed on within 3 to 5 days after submitting subscription documents. Obviously, this is much faster than a traditional 1031 exchange purchase. And once again, the reason why this can happen so quickly is that all the due diligence has been done already. The real estate asset managers have gone through their whole escrow period. They've actually fronted and or produced the initial capital to acquire that property. They've acquired it, they've set it up as a DST, and then they will sell off the interest to 1031 exchange investors on a one-off basis until they have met that specific capital raise, predetermined capital raise. So it's they're once again, the DSTs are set up to make it as easy as possible for a 1031 exchange investor to transact and participate in this way. So we're going to talk about some examples. So starting at a high level, mentioned this a little bit earlier, we offer anything from multifamily apartments, long-term net lease properties, healthcare, medical properties. We do all cash, we do leveraged, we do self-storage, a little bit of office, retail, pharmacy. I mean, there's all these different types of properties that are represented in the DST space. And this next section, we're going to go through a few past examples. I'm not going to spend a lot of time here because we're coming up on 45 minutes here, and I want to get to the end of the conversation here. But these, once again, these are past DSTs. A majority of these are all cash. They happen to be all cash. As I mentioned earlier, we do also offer leveraged DSTs, but I'm going to fly through this. So this is a debt-free townhome community in the Nashville MSA. This is a debt-free Walgreens in Phoenix, Arizona. This is a industrial distribution facility in Sterling, Virginia, leased to Frito-Lay. Here's an industrial facility leased to FedEx Grounds. This is a medical facility leased to Fresenius Kidney Care in Atlanta, Georgia. This one is leveraged. This is a multifamily, a 50-unit multifamily Class A in Houston, Texas. Here's a last mile distribution facility leased to Amazon in Akron, Ohio. I told you I was going to fly through those. So kind of the tail end of the conversation here, we're going to talk a little bit about more about K properties in terms of how we approach the space and what we offer. And then, we're going to close and transition to some Q&A. So I appreciate everyone hanging in there with me. Hopefully this has been helpful, but I wanted to go through the client's investment process. I think this is really important for investors to understand what the level of engagement looks like, with our investors. So the first part is going to be that introductory consultation. So that's where, we just begin the dialogue. We get to know, the investors. We understand their situation, what they're looking for. And then from there, we start to map out preliminary recommendations. This is also where we'll provide additional educational information. We really want to get them up to speed with every aspect, all the ins and outs of the DST structure, right? So we develop the initial kind of proposal, answer all their questions. Then the next section would be the follow-up assessment. This is where we review all the different offerings, what we've proposed, and really get the investors' feedback. That's really important because, like I said, every investor is a little different. Some investors have an affinity towards certain property types, certain areas of the country over others, and we really want to know that. That's really important in terms of what we do. The next element would be, meeting the team. I personally am in our headquarters here in Los Angeles. We do have offices all across the country. We do this in person, virtually, conference calls. And then, we're working with the investors and, leading into their 1031 exchange window. Say the sweet spot is probably about 30 days prior to the expected close of escrow, that we would really sink our teeth into the various offerings, come up with a plan so that once we begin that 45-day window, we have a pretty good idea of which direction we're going to go. And that, we work with them through the actual transactional process. We have a great transactional team that, works with the investors every step along the way, facilitate the smooth transactions, completion of the 1031 exchange. And then it doesn't stop there. We really pride ourselves on continuing communication and education. For many of our investors, this is not a one-time transaction. This is a lifetime relationship that we have with them as they're with us, years and years and years and years going forward. Many of our investors, they continue to 1031 exchange into DSTs from DSTs that have sold, or they, look to sell other properties. So we really pride ourselves on being that voice and education communication source for many years to come. So just in closing here, I mentioned we're headquartered in Los Angeles. We have offices all across the country. What's unique about us is we do specialize in DSTs. So this is something that we've done from the very beginning. Our founder started in the real estate space in the early 2000s, transitioned to DSTs in 2007. And really from the early 2000s to today, we've worked with thousands of investors, billions of dollars worth of DST real estate, thousands of transactions. And we've really kind of prided ourselves on being the specialist, right? We want to do one thing very well. And that's what we bring to the DST space. That translates into a greater amount of potential options. We do, work with, I mentioned, 20 plus different real estate companies. We have, over 400 years worth of team experience, $30+ billion worth of DST real estate transactions. Our founders invested in over 75 DSTs, as well as many of our, executive vice presidents as well. And really, just to close here, we really pride ourselves on dedication, to our client. We joke that the 45-day clock does not stop ticking, and that includes weekends, holidays, and we're always available to our clients, whenever needed. We're featured in, many of these publications that you see here today. And, I would encourage everyone, we do have a great library of education. You can get a copy of today's webinar, the slides of today's webinar, on the site, kpi1031.com. So with that, I really appreciate everyone's time today. I'm going to turn it back over to Alexandra, and I think we're going to go into some Q&A.
Sorry about that. I put up a poll question to ask if you do want to start that process. I'm really glad that you went over that process, Matt, because that's really helpful to show kind of from A to Z what y'all do and what that can look like. We definitely did get some questions in the chat, but if you could put some questions in the question box, anyone who still has questions, that would be helpful as well. We had quite a few. One is from Carrie. Actually, there's two Carries, but they spell their name differently and they asked a lot of questions. So the Carries have questions. Carrie asked, can they invest part in a replacement property and part into the DST?
Great question, and the answer is yes. Absolutely, we do have investors do that with a certain level of frequency. So absolutely.
Great. And can you choose where and what you want to invest in?
Yeah, also, yes. I will caveat that to say that the 1031 exchange exists on a certain time frame, right? We talked about that in the presentation. So over time, DSTs come and go from the time that a new offering is put out to the time that it's fully sold out is usually in the range of 1 to 4 or 5 months. So within a certain window of what's available, absolutely, but it's all going to be, time specific with the 1031 exchange.
That makes sense. And do you get depreciation?
Yeah, good question. So part of that operating statement that I mentioned earlier is going to break down the value of the land and the value of the improvement of the building. And so the investor is able to calculate their ownership percentage of each of those items. And then their CPA would be able to divide that against the depreciation schedule for that specific property type. I will say that everyone has a different basis coming into the property. So, we always, encourage investors to, consult with their CPA on that to see, how much they're able to take.
Okay. And what is the loss risk for a DST?
Yeah, I mean, I'd say the loss risk is similar to, any type of real estate, and, especially if we're talking about a leveraged investment. Your biggest risk is if you're not bringing in enough income to successfully pay your debt service month over month. And then there's also some risk, and we're starting to see this a little bit in today's environment with loans coming due, right? Especially if loans were initially structured at lower interest rates, and we're now in a much higher interest rate environment, and that can pose, a certain challenge to certain operators. So I'd say, it really obviously is property specific, but it comes down to the underlying performance and what that property is able to generate with the circumstances that it's been dealt. And the ability to address the loan within a certain time frame. Of course, there's still risks with the all cash debt free properties too, but you just don't have to worry about someone else taking that property away from you.
I'm sure the risk also varies depending on whether you're getting into storage or office space or medical, whatever it is as well. On top of that, that's like another layer where maybe there could be some variance, but I mean, you do vet the properties and go through that due diligence process. So that's also something I think that can help to reduce the risk. So from Carrie also, what is the average return on your trust properties? And does the DST pass on dividends? What about capital gains and losses?
Great question. And I always caveat this response to say each property is different. We always encourage investors to read the full private placement memorandum, which is the official, offering document for each of these. In terms of how immediate returns are projected, is in the context of what we call a cash on cash return. So simply put, that's the net cash flow that an investor's expects to receive. Of course, there's no guarantees. It can be more or less, but expects to receive based on their initially invested equity principal as a function of a percentage. So in today's environment, we're mostly in the 4 to 6% range. That can change over time. We've seen it be a little bit lower. We've seen it be a little bit higher, depending on the section of the cycle that we're in and the economy at large. And as I mentioned earlier, the investors are entitled to their portion of the net proceeds. We hope that all these properties sell for more in the future than they were initially kind of packaged together for. And in our experience, majority of the time, it's actually worked out that way. We've been very fortunate. We've been a part of, thousands of these offerings. So we have had properties that have sold for less than they were put together for, where investors have, lost money as well. So we've seen both sides of it. I will say, most recently, we've seen a lot of these properties do very well, especially in the last couple of years with what's kind of transpired coming out of COVID with the super low interest rates and just asset levels swelling to levels that we haven't seen or never expected to see. So we're coming off of a lot of recent success. Will that continue? We don't really know. What I think our role is more to control what we can control. Going back to what I was talking about, the most obvious ways we do that. One, diversify, right? We don't want to have all of our eggs in one basket. Second, we try to eliminate as much debt as possible from the equation, or if we do need to take on debt, we'd rather do that in certain property types versus others, right? We'd rather do that in a property type that has hundreds of renters that are collectively obligated to pay rent on a monthly recurring basis versus just one, tenant or one, lessor. So there are ways we can kind of mitigate some of that risk. And I think, to kind of summarize everything, what we're trying to accomplish here with the DSTs is first and foremost, preservation of principal, right? That's the most important thing for our investors. We want to preserve what was initially invested. Follow that by a consistent, durable income stream. So that is why you see in the DST space, typically newer Class A properties, more of that institutional caliber, where you have a certain level of predictability that you might not have in other classes of real estate. And then the last part is hopefully some modest, equity appreciation. Once again, this is going to vary historically by asset class. Multifamily properties historically have been a better performer by way of appreciation than, say, something like a single tenant net lease commercial type property. So all of these discussions and aspects are a part of the process, right? We want to understand what is most important to the individual and how can we structure, a portfolio solution for them within the context and environment that we're in today with what is in our control. So.
And does that income stream typically come in monthly or annually? How does that work?
Typically monthly. Yeah, every single DST I've worked with has been monthly.
Okay. Also, let's see if I can find the other one here. DST fees, any ballpark range on that?
Yeah, good question. So there are fees in DSTs whenever there's someone else packaging, putting together a product. Inherently, there's going to be expense there. The way that the DSTs operate is the fees are going to be packaged into the value of the investment offering. So when an investor comes in and subscribes to a DST, they're paying a little bit of a premium as part of that initial acquisition price, right? And I will say all of the fees are fully disclosed in that private placement memorandum that I keep referring to. And it's an item by item kind of list of where every single dollar is going. And this is something we review with all of our investors. So there's that kind of upfront premium cost, if you will. There are some continued management related fees, whether it's like a property management fee or an asset management fee. And then on the very end, there's what's considered a disposition fee, which is a small fee that the DST company is entitled to at disposition. So I would, encourage anyone who wants, more granular answer to that, definitely reach out to us. We'd be happy to, walk you through exactly where that information can be found and provide, more context there.
Perfect. Laura asking, let's say I sign up for a traditional 1031 exchange and it's day 40 and I still can't identify any appropriate properties. Can you quickly switch to a DST?
Yeah, and we do. I have many stories of investors who do that actually. You'll be surprised. But I think that's a good question, and something I didn't mention during my presentation is even if the DST isn't a primary option for investors, which it isn't for everyone, there are plenty of investors who will use this as a backup strategy or a cover strategy. So going back to your first question, Alexandra, like combining it with another property. Some investors they'll go out and they'll try to find a replacement property. Let's say that value comes in a couple $100,000 less than what they sold for, then they can combine and use the leftover funds to complete their 1031 exchange by purchasing a DST. On the backup front, we do work with investors who have identified traditional real estate that they're still going through due diligence on, and they want to list one or two or several DSTs on the list just in case something materializes in due diligence that they're not comfortable with. And you'd be surprised. I mean, a lot of things happen, in real estate transactions, and it's better to have something to consider than nothing at all, is what most investors kind of decide. And just because you identify a DST doesn't mean you're obligated to purchase that as part of the exchange. And if there's adequate space on the identification sheet, it's kind of like a why not situation for investors in that, in that circumstance. So really good question. I'm glad it was asked because I didn't mention that earlier.
Right. Robin asking, if I die, will the DST pass to my heirs?
Yeah, good question. And the answer is yes. So what typically happens there is the estate would get in touch with us or the DST company, and they would essentially work to either reassign, the interest pursuant to the investor's will and trust, or kind of reorganize how that DST is held from a titling perspective. All the same like typical benefits as it relates to the step up in basis and all that would apply to DSTs, just like any other real estate transaction. And that's a big part of the whole equation for investors, is that estate planning piece, is being able to allow their estate to kind of inherit the DST real estate and receive that step up in basis that they're entitled to at passing.
Yeah. And it's so much easier to inherit a DST than it is a whole rental property if your heirs don't feel like becoming landlords all of a sudden. So that's another great advantage. Or even splitting it, I think too, that's always a issue. How do you split it if you have 4 kids, and some of them want to be the landlord, some of them want to sell it. It becomes complicated. The DST is pretty easy. So Seferino saying, I have a townhome that I bought years ago. If I sell it, I pay a large capital gain. Do I fit into your program? Is that something that you could help with? So that townhome, I'm assuming he's renting it out to someone. So it can be any kind of property, right? It doesn't have to be like an apartment building per se.
Correct. Yeah, any type of investment real estate. So yes, assuming it qualifies as an investment property and the individual qualifies as an accredited investor, then they would be able to consider DSTs as an option for their 1031 exchange.
Okay. And also, how long, I think you said this, but how long are the DSTs usually held for?
Usually 5 to 10 years. Each offering is going to provide a business plan where the DST sponsor company will map out their plan of attack, for that specific investment. And typically they'll give a range. So say, 7 to 10 years or 5 to 7 years or, 3 to 5 years, whatever it is. They'll identify a window that they intend to operate within. That being said, we've seen DST properties that had an initial 7 to 10 year hold plan sell in 2 years, or, property that, was 5 to 7 that has gone, for 10 years, right? So there is some variance there. And I think it's important to note why there is that variance is because ultimately real estate specifically is inherently a longer term strategy, buy and hold strategy in most cases, right? It's, especially with the DSTs. And, the operators are essentially trying to maximize the ground floor operations to grow the net operating income and create value as much as they can, but also combine that in an exit environment that is most congruent with the real estate cycle that would lead to the greatest potential return for investors. So, I always say if the plan was to hold a DST for 5 years, and in 5 years, we're in 2008 all over again, then that DST is not going to be sold, 5 years from today. Why? Going back to what I said earlier, the priority is always preservation of principal. And so these companies, they're not gonna sell at a loss. And they're not going to obligate themselves to do so by determining a specific date in the future that they have to exit by. So, it's for, I think intuitively it makes sense, but some investors are maybe initially a little concerned of not knowing exactly when that event is going to happen. So definitely, an important concept to kind of discuss. So good question.
Yeah, definitely. I think one of the main differences between holding your own real estate investment property where it's up to you whenever you want to sell. But also real estate is cyclical. So, if you do hold it long enough, inevitably it does go up. So I think that's smart anyway. Regardless, if you're investing yourself in real estate and the market goes down, you wouldn't sell at that point, right?
Right.
So it's the same thing. So Vishal is asking whether K Properties collects fees for managing the DST, and someone else had asked earlier as well how your fee structure works, and so how's K Properties involved in that?
Yeah, good question. So to clarify, K Properties, we are not a manager. We're not an asset manager. We're not involved in acquiring these properties and staying on to manage them going forward. So we're not compensated by any way of management fee or ongoing fee. I think the best real estate analogy for what we do is think of us as a buyer's agent. Instead of working with investors to purchase traditional real estate, we work with investors to purchase DST real estate. So our compensation is pretty much identical, although it's a little different because we operate in the securities world, but we earn a one-time transactional commission upon the initial purchase. Our commission is factored into the price of the DST, so the investor doesn't have to necessarily come out of pocket and pay us anything, although it is considered into the into front transactional fee. Once the transaction takes place, we're no longer involved until that investor decides, or if and when that investor decides to reinvest with our company back into another DST, in the future. And, that's really important to us. And that's a big part of, from our perspective, why we pride ourselves so much on continuing, these relationships I mentioned earlier. But I think over 35% of our revenue every year as a company is through repeat, investment. And this isn't a one-time, one-off transaction for most of our investors. It is kind of that lifelong relationship. But yeah, that's how we're set up. That's the best analogy I like to give.
Great. That makes a lot of sense. Karen asking, can an investor sell their shares before the property is sold?
Really good question. So the answer is yes. The DSTs are technically considered sellable securities. So interest can be bought and sold at any time along the way. That being said, in reality, there is not a firmly established or an official secondary market platform that exists for DST interest. So in reality, we rarely see people sell out early, and we always encourage investors before you invest, you need to be committed to seeing this thing through, right? Going the full distance with the DST, which the eventual liquidity event would be when the entire property sells, right, in the future. So investors need to be comfortable with that. We understand life happens, right? Sometimes, things come up, medical expense, family emergency, whatever it is, where investors need to get out. And so it is possible. The reality of what this would look like is that investors' interest would first, in most cases, be offered to the other investors in the group, or the DST company would make others aware that, the investor is trying to get out. There's usually some time of right of first refusal or a period of time that the other investors in the group have the ability to make an offer. If nothing comes of that, then it just goes to the open market. We'll call it the open market. And that's when we would effectively get involved, and we would reach out to our clients or other investors who may be interested in buying out that investor's interest on this kind of pseudo secondary market. The give is that the price at which the investor is going to sell is negotiable, right? So you have a lot of investors who would be interested in buying someone out early, but at a 10% discount or and 5% discount, whatever it is. So that is the reality that exists. We probably handle, a couple thousand like primary transactions a year, and anywhere from 3 to 10 secondary market transactions a year. So they're very few and far between. Super long-winded answer to your question, possible, but not advisable.
I'm glad that you did put it in that context, though, and went through that detail, because it's a question that we get quite often as well about DSTs. And ultimately, yeah, I mean, it is a longer term hold strategy. It's not a, flip property, it's something you got to keep and hold on to see the real return come through. Let's see here. What's the minimum raise for your company to get involved in a deal? Asked Vishal here.
So on the offering size, we've done anything from $3.5 million all the way up to almost $1 billion DST value. So there's a pretty wide variation. I would say the majority of DSTs land somewhere in the $15 to $20 million range, up to about $100 million range. That's typically kind of the sweet spot, although there's always going to be variation. On the investor level, I mean, we've worked with investors who have done, a $50,000 exchange. We've done exchanges with an investor who did a $65 million equity exchange in DSTs, and everywhere in between. So that's, another kind of like what I was talking about earlier, another benefit of the lower minimums is we can accommodate, a very large variety of potential investors who, would be interested in this approach.
Well, especially in today's real estate market, you can't really buy hardly anything for, I can't think of anything you could buy for 100,000. Maybe that's because I'm in California. Yeah. But yeah, that makes a lot of sense. Okay, well, I think we've finished up with all the questions, and they were really good. So everyone, good job on the questions. Good job on answering them, Matt. More importantly, you did just a really thorough explanation on a lot of these questions that we get quite often. So I hope you all learned something new. I am going to send everyone the full recording, and I'll also send you the contact information for K Properties if you do want to go ahead and do that. If you did say yes to the survey that I put out, then we'll automatically connect you with their team. And if you have any questions, you can always ask them. But I'm glad that we were able to answer all the questions, at least on this call. So I really appreciate your time, Matt. Thank you for coming on and talking to our group. Oh, and one last thing, everyone, please take the exit survey as you leave. We'd really love to hear your thoughts and feedback on this webinar and any suggestions for future webinars as well. So again, thank you, Matt. Appreciate it.
Absolutely. Thank you, everyone. Really appreciate your time.
All right, everyone. Take care. Bye.